last week. Congrats. Rang bank to ask for a better rate on my mortgage. Achieved a slight reduction. That one's exciting. Shares went off a little. Money loss. Airbnb discount of $170. Amazing. Okay, cool. So many good wins. Yay. Back to debt recycling. I am Tash, for those of you who don't know me. I've worked with Pearler for gosh, like 5 years now, maybe a bit longer since the end of 2020. I do a content partnership with them on my social media, but I've recently started a mortgage broking business called Tash Lends, and we're partnering with Pearl to do a bit of educational content. And I've got Ro with me here today, who's one of the mortgage brokers. Ro, do you want to introduce yourself quickly?
Yeah, hi everybody. My name is Ro. I work with Tash. I'm one of the mortgage brokers here. Me and Adam, really, we're really taking the swing of things, and yeah, happy to be here and present a little bit, information about debt recycling today.
Yay. Ro has a fun background. He used to work at Macquarie, which is very handy because we like Macquarie as mortgage brokers. He also used to work at Aussie as a broker too. Oh, sorry. So today's agenda, we'll talk about what debt recycling is, the impacts of the federal budget and how things have changed a little bit, how to actually set up a split loan, detailed examples, and then actually, no, we're not going to do the detailed examples today. Change that one. And then the risks and drawbacks of debt recycling. If you have questions, please ask them as we go, but we'll have time at the end to answer them as well. Some fun disclaimers. This just pretty much says that this is not personal financial advice in any way. If you want personal financial advice, please chat to a financial advisor, speak to a mortgage broker about loans and borrowing and lending, and chat to your accountant about any tax things. So, what is the issue we are trying to solve with debt recycling? With any tax strategy, it's important to try and go back to like, why are we doing this? Some things sound fun and fancy, but we want to make sure we're actually trying to solve a problem. So, the problem here is interest on loans for the home you live in are not tax deductible. You can tax deduct the interest on your investment properties, but the home you live in, you cannot usually. This is where negative gearing kind of came in. So negative gearing is when the cost of holding an investment, so the loan interest and expenses, exceeds the income it generates, producing a loss, and you deduct that loss against your other taxable income, like your salary. So for example, if you have rental income of $30,000 a year and the interest and expenses is $40,000 a year, you've lost $10,000. That $10,000 reduced your taxable income. If you have a 47% marginal tax rate, the ATO effectively refunds 4,700 of that loss, but you're still out of pocket $5,300 in cash terms. Now, the federal budget did change this, and these are only proposed changes. They're not completely locked in. But with residential property, the proposed changes are no negative gearing on properties bought after budget night, so the 12th of May, from the 1st of July 2027. You can carry forward the losses, but you can't deduct them against your personal income. If you own property already, you're all good. You can keep doing it. And if you buy or if you build a new home, you will be able to access it too. The fun part was that they said that these changes only actually applied to Oh no, someone said a typo. Sorry if there's a typo. Oh golly, there is a typo. Let's not look at that one. Ignore that one. Um, the fun thing was in the budget, they said the changes applied to residential property, but not to commercial property or other assets like shares. So we can still benefit from debt recycling, which is very exciting. Over to you, Ro.
Thank you, and yeah, thanks for pointing out the type of federal, I think it was called. So that's thanks, Brendan. There. Hi everybody again. My name is Ro, and welcome to Planet Earth. Today we'll be talking about debt recycling. How exciting! Now, what's debt recycling? Debt recycling is a strategy where you're basically converting your non-tax deductible debt, which is the debt on your principal place of residence. And what we do is we convert that into tax deductible debt, and at the end of the sort of June period, you can sort of claim that back with the ATO. Next slide. One of the things I'll probably go through is, debt recycling is a strategy, and it can turn into a tragedy pretty quickly. And then we're here to give you a little bit of guideline on sort of how to smoothly process that through. So what do you need to do is You have a home that you live in, and you also need to have a debt on that, of course, but you also need to have a little bit of surplus of cash to be able to invest. Now, in terms of how we're going to achieve debt recycling is basically you're using any extra money that you have to pay down the home loan, and then effectively what you're doing is you're reborrowing that your own funds. And then creating a separate home loan, which we're going to show you in a bit how it works in terms of mapping. And that reborrowed sort of funds are invested in basically income producing assets, such as shares and managed funds. And at the end of the day, because you're now borrowing that money and you're using it for investment purposes, which in the ATO's term is you're using to purchase an income producing asset, then what effectively happens is that debt now becomes tax deductible. The one disclaimer I'll put down there is, so in terms of purchasing the asset class, definitely speak to your accountant about what asset class you should purchase, because there are some deductible and some non-deductible. So generally a misconception, but the broker here is at the center of sort of structuring the loan and liaising with the bank.
Yeah, so think things like shares. Yes,
Mm,
ETFs usually pay dividends or distributions,
mm.
but something like gold, unfortunately, will probably not pay you an income.
So here's a pretty simple sort of mapping of how we're going to achieve this. So say you have savings that's worth $50,000 and you have an existing mortgage of $600,000. So what you're basically doing is you're taking this savings and you're paying down your non-deductible debt. And here in this below example, you can see now the existing mortgage becomes 550, and you have no savings. Cool. So part of the process is what we now do is we now split that $50,000 worth of loan, and you still have the 550 in terms of non-deductible debt, but because now you're splitting the loan, and we'll show you in a bit of a later example that $50,000 will convert into a deductible debt. Your total debt will remain the same as before, which is the $600,000. There you go. So this is the before and after picture there. You can see that your original debt limit stays the same. And then you've got now two splits. And with the two splits, the $50,000 is the deductible debt where you're actually purchasing the shares or the ETF. And we're going to show you a bit later how sort of to claim that.
Does anyone have any questions about this so far? We've got one come through. I'd love to know if this approach means that since income from the home loan will be used for investment purposes, if there is any capital gains tax on the property when selling it, even if it's a residential home.
This
Um,
sounds more like sort of, a liaise with an accountant type of thing. So technically, well, the shares will attract capital gain tax. It's not the debt. The shares will attract the capital gain tax, because when you're selling the shares, you're basically paying the capital gain tax on the shares itself. So yeah, but definitely a
yeah,
question
but
for an accountant.
it shouldn't change the capital gains on the principal place of residence because you're splitting it into
No,
two separate things. So the home loan for
no.
your property remains separate to the loan for the shares. So the capital gains will be
Mm,
different for both of them.
yeah.
Do the recent proposed changes to the budget impact the strategy? No, I don't know if you were here at the start, Louise, but I did have a slide briefly on this where it changed for residential property, but not for other assets. So commercial property and shares are still fine for this kind of strategy. What's an ETF? An exchange traded fund. So it is a basket of shares. So instead of buying like just Apple or Nvidia or Meta, you might buy something like the ASX 200, where you have the top 200 companies in Australia all in one investment. So some people say shares, but also they just buy ETFs. Perla has lots of good resources on ETFs, so head there if you want more info. When you say pay down, where are you paying down, Ro?
Good question. So, if you want to talk a little bit of structure, happy to sort of kind of book in an appointment and show you in detail. But just a high level overview is you're effectively, like your repayments, you're paying down the loan. So basically, you're putting the money into the home loan.
Yeah. Do
Hopefully that
you,
answers the question.
yeah, let me know if not, Andre. Do you
Hmm.
have to create a new split loan or can you just pull it back out? I've heard mixed views on this.
Uh, Look, for accounting purpose, what you want to do is you want to keep it clean. For accounting purpose, yes, a split needs to be created there because we'll talk a little bit about the risk in a bit. I'll tell you exactly why it's a good idea to create a split, and that's how the ATO like it.
Yeah. Can you show step one, please, again? And do I need to have spare cash from the get-go? So you either need to have spare cash to pay into your home and then redraw back out, or you need to have a home that's increased in value that we can refinance and take the equity out, is how I
Uh,
understand it, Ro. Is that right?
Yeah, yeah, absolutely. Look, the idea of debt recycling is it's about turning your non-deductible debt into something that you can claim tax on. But if I think the question sort of relates to, if you don't have cash and you want to purchase shares, how you can do that. You can certainly do that by sort of, by borrowing money and sort of making that new split tax deductible. Of course, there's a strategy involved in that because what you're essentially doing is you'll be borrowing money, same principle as debt recycling, but then anything that you earn, you're putting that back into your to your mortgage. A little bit of strategy involved there, but happy to have a chat when you're booking an appointment because that will be a bit more lengthy discussion.
Yeah, I understand that like step one might be a bit confusing. I kind of like this slide better. So just think of it
Mm,
as you have $50,000, you've paid it into your home loan, and then you've pulled it back out as an investment loan. So this kind
mm,
of shows it in the end how it looks for. So you've had your $600,000 mortgage, you
mm,
had your five, you've paid 50 grand into your home loan, you've then you've pulled it back out, and then you've bought shares with it. I hope that flow makes sense. Um, the extra payment to the mortgage has to be done as a lump sum, or can it be done with small sums over time?
Definitely can be done with small sums over time. And then once you reach to a certain limit, you can do debt recycling there.
Yeah, so I think yeah, you can pull it out ideally as one bigger sum, but you can put it
Mm.
in as lots of little sums.
Yeah, again, a little bit of strategy involved there from my end because the restriction here then becomes really, what the split amount that banks sort of allow as well. Not everybody would allow, 5,000 or $10 split. They will have a minimum, but yeah, there's a way to sort of way around that.
Yeah, and there's fees to consider as well, which the mortgage
Mm,
brokers will chat to you guys about. But I
mm,
just
mm,
split my loans to pull out equity, and like each split had different fees for the bank that I went with. So that's something to consider as well in terms of how much you're pulling out. But the mortgage brokers will
mm,
run the numbers for you if that's something you want to chat about.
mm,
Lots of questions about if you don't have savings but equity instead.
mm,
Yes, we can definitely refinance if you have the borrowing
mm,
capacity. That's a big disclaimer as well.
mm.
Questions about dividends. Isn't franking credits already saving on tax? How would debt recycling benefit us on top of that?
Great
Um,
question. That's a
yeah.
very, very good question. So, yes, you get franking credits. That's for the dividend, which means you do not get tax on the dividend part of it. But imagine you get that existing benefit with the shares. If you have a sort of non-deductible debt, imagine getting tax back at the end of the year as well. So, for example, I'll do a rough math here. Someone that's earning $100,000 and say you have $50,000 worth of shares at 6%, that's pretty much you're paying about $3,000 per year. Now, the tax bracket is about 37% on that margin there. So which means you're getting a little bit of money back from at the end of the tax year, which is additional savings. Why would you not have that?
Yeah, so I think about it a bit differently where the franking credits are tax on the income that the shares provide, whereas we're talking about with debt recycling trying to claim the interest that you're paying on your mortgage. So you're already paying
Mm.
interest on your mortgage. We're trying to make some of that a tax savings as well instead of not saving any money on tax there, but you'll still also get the dividend franking credits too, which is fun. And then if you buy more shares, you'll get more dividends, hopefully, anyway.
Ooh, lots of interesting questions.
Yeah. Do you want to run
Yeah.
through the slides and then we can come back to these, Ro? Do you think that's
Yeah,
easier?
easy. Yeah,
Okay.
100%. I think there's a million questions here, but yeah, easy. Good to know that people are wanting to understand a little bit more. Now, look, we'll quickly go through some of the risks. Um, and this is where really the strategy can turn into a tragedy, like I try to say. Um, so with the risk. the risk is that if you do it yourself, you can contaminate or mix the purpose of the loan, or have an incorrect structure, or even interest rate and interest rate type. Because I've seen quite a lot of people pay sort of very high interest on that when there's not necessarily the need to. And finally, I'll probably say one of the main things for me is not being with a suitable lender. I believe we had a question, I can't remember the name, of someone saying, "Oh, my lender doesn't allow for me to split the loan. What would you recommend?" I'll probably say that, that's the incorrect lender that you're with. If debt recycling is your strategy, then you definitely need to be with a lender that would suit that. Now, the impact of all of the debt recycling and not doing correctly is definitely higher fees at tax return time. If you haven't done it correctly, the accountant's going to charge you a lot more, and then then it really becomes, oh, would it have been worth it for me to do the debt recycling in the first place? The second one is reduce or loss sort of tax deductibility. If you do it incorrectly or purchase the share incorrectly without advice, then the ATO doesn't like it. You're not going to be able to claim it. And finally, one of the biggest costs is restructuring. If you haven't done it correctly, you might, in some case, have to resell the shares, refinance, and then restructure it. So, which is going to be a lot of hassle and quite a lot of cost involved in that.
Mhm.
Yeah. Before we before we get into this one here, so the final thing I'd probably like to say in terms of the risk is, don't let Jesus take the wheel. Is let the mortgage brokers sort of kind of give you a little bit of guidance there. The reason is because, I mean, we provide a free service, so might as well sit down and have a chat with your broker about the strategies, and then you sort of liaise with the accountant, so to sort of discuss on what asset class you need to purchase. Okay, so a couple of the things that we need to consider. Definitely consider your cash flow. Look, if your cash flow is tight, is debt recycling really worth your time? Second one is the investment time frame. If you're looking for a shorter term, in terms of, just want to buy and sell the shares within 1 year or 6 months, probably not for you. The other one is your risk tolerance. What that means is, obviously, shares price go up and down, and so does interest rates as well. So is that really within your risk tolerance to do so? And fourth one for me is having a little bit of backup and emergency funds. So if you don't have backup or emergency funds, do you really want to go down that route of doing so? There are strategies in place where you can borrow and then still have backup or emergency funds and do that. So, but please definitely talk to your the mortgage broker, and obviously the time frames there. It can sort of, it's not as easy just to go and purchase shares. It's about restructuring your debt, having that conversation with the accountant and the broker, and then sort of purchasing the shares. So the time frame that you can purchase the shares will be slightly more. But once you do it, and it's quite easy to do it the second time. The drawbacks, I think I briefly discussed this. So it all boils down to your risk threshold. The investment value might go down. You're going to have to be okay with that, because there's different sort of waves that will come through. The interest rate, we've talked about that. There is the initial complexity at the start of purchasing the shares, but again, the broker does that for you. And finally, the access to savings. You're going to have to be comfortable now not being able to access the savings instantaneously, because it will be in the shares. There's a little bit of process of selling that if you really want to access those shares. That's when the emergency funds comes in place.
Yeah, definitely.
Yeah.
It's definitely a safer option to pay off your mortgage and not reborrow the money to buy shares, because like Ro said, if investment falls, you may have shares that are worth less than the loan that you have for them. So that's something to
Mm,
consider.
mm,
Maybe we will actually, let's see what my other slides are, and then we'll go to some questions.
mm, mm,
Okay,
mm.
cool. These are the next steps. If you want to chat to our team, you can book in a call with us. We'll talk about if you can actually borrow your borrowing capacity, equity, how this actually works for you, do a whole structure for you. Someone asked a question about accountant and financial advisor. So we can't tell you exactly what ETFs to buy. You'll have to see a financial advisor for that. And we can't give you specific personal tax advice. So ask your accountant, but we can give you the structures for how it would work. Um, a question from Nick. Let's say my mortgage payments are $4,000 per month. If I split my loan into two products, will that mean I'm still paying the $4,000 just split across two payments? Same debt, same repayments.
Good question. If it's P&I, then yeah, of course, there's no reason that should have changed. But the strategy here is, if you split the loan, for example, right, and if you want to preserve your taxation benefit, you can opt for interest only. So that does two things. One, actually, that does three things. Capital preservation, it does accelerated debt reduction as well. Sorry, debt reduction, not death reduction. I would love a death reduction in my lifetime. And obviously that boosts your savings as well. So few strategy involved there, but ideally if you're splitting your loan and just keeping P&I, then yeah, it will remain exactly the same. There's no point for it to change.
Does it have to be investment for the split if you're using it to buy shares, or you keep it as
Good
P&I?
question. I've seen quite a lot of people actually have the wrong sort of mentality about that. So the ATO and the banks don't technically talk. So don't tell the ATO I told you this. So what that means is you could actually borrow under the owner-occupier rate as well. But again, it's quite detailed. There's no blanket answer to any question in broking. It's really us sitting down and sort of looking at your finances and finding out what is the best rate we can achieve this in. Because obviously, why would you want to pay additional interest rate? I had a client once when I was working for the bank. He had about $1 million worth of debt, which he debt recycled, and yeah, that was on a pretty high interest rate, which is unnecessary. And
Yeah.
so I managed to sort of pull it down, and he was extremely excited about that, a bit of cost savings.
Yeah, definitely. When I've split mine recently, which is a bit different to this situation, but my interest rate went up because I've got portions that are interest only now, but then the repayments for that are lower. So it's kind
Mm,
of cheaper overall, but then I'm not
mm.
paying down the principal in the same way that I was before.
Yeah.
Does this apply to PPOR as well? Yes, the strategy we're talking about is if you own the home that you live in. If you own an investment property, this doesn't really matter because you can already tax deduct the interest. Unless with the budget changes, that does change a little bit. But yeah, we're
Mm.
talking about principal-based residence for now. Say it was 100% split, $600,000 repaid and used it for shares. What happens when you sell the principal place of residence?
Nothing. General
Yeah,
rules.
because it's two, we're like borrowing again for a separate loan. So yeah.
Mm.
So your bank has to create a split loan.
Yeah, I mean, the bank definitely has to create a split loan for accounting purposes. Again, if you want the accountant to love you at the end of the year, then yes, you have to create a split. But if you want your accountant to hate you, then what you would do is you would not create a split, and that's when you will contaminate. Plus, you'll mix the purpose of the loan, which eventually is going to cost you a lot more money at tax return. So be very careful with that. Again, speak to a broker.
These two are quite related. How does interest rates usually differ between the home loan and the investment loan usually? And then the second question was, what sort of interest rates are the investment loans attracting currently?
Good question. So there's no general rule of thumb. Everyone has their own sort of way of calculating the risk and how they price the risk. I'm talking about bank calculating the risk and pricing the risk. But you'll generally see between 20 to 40 basis points, my apologies, difference between the owner occupier and the investment. And it will be very similar margin and threshold, risk threshold in terms of pricing for interest only as well. I do believe currently the owner-occupier interest only is slightly higher because the banks have now deemed it as the higher, riskier sort of repayment type per se. So you're paying a bit higher. And in terms of what the general interest rate is at the moment, again, it depends on the loan to value ratio and it depends on the bank you're going to. So I'll probably leave that question out for the moment.
Can we say like roughly like low sixes you're kind of saying? I know it depends.
Six, sort of this owner occupier, one of the good rates to go at the moment is 5.89-ish.
Mhm.
So it's still under 6%. But in terms of investment, you add 20 or 40 basis points to that. So you're looking at that early six, 6.1, or it's between 6.1 to 6.3 is what you're
Yeah.
looking at.
I'll
Yeah.
have to double check mine, but I'm pretty sure mine was like 6.09 and then like one was
Mm,
6.2 something, to give you a rough
mm,
idea, but definitely chat to a broker. I've also put on this next slide here,
mm,
just some resources. We've got a borrowing capacity calculator on our website if you want to go and play around with that and play around with your numbers. These are other resources that you can get to, but I'll chat about these later actually. Let's
mm.
keep doing questions. Is there a level of income that the asset needs to produce for the ATO to accept it?
Nope.
No, yeah, as
No.
long as it makes an income, I think. But chat to your
Yeah.
accountant about that one. Which banks provide split loans? Is it only the major banks?
No, that's incorrect. Most of the banks should provide the split loan. However, the caveat there is the amount of split. All different banks have a different amount of splits. And then the second caveat is the amount of splits you can actually have under one facility, as they like to call it. So you really have to, hence why we recommend talking to a broker. It's not about the reason is it's not about just splitting your loan now to do that one debt recycling, because it could mean that you want to do further things. So you just have to be with the right lender there.
Mhm. Can you increase your loan amount rather than having 50K savings to offer? For example, can you borrow another $200,000 so you owe $800,000 for a $600,000 home loan and $200,000 for shares?
Yes, certainly you can. There's no restriction on that. So what you're really trying to do there is you're increasing your debt by another, $150,000. Obviously, because you have the $50,000 in shares, but you also want to preserve that $50,000, which we talked about, the emergency fund. So good pickup there. It is an alternative strategy there to sort of kind of do debt recycling, where you're technically just doing the $50,000 debt recycling. And then also keeping the $50,000 worth of emergency funds. A good pickup on that one.
Yeah, you just need a
Yeah.
property that's gone up enough in value and you need to have the borrowing capacity to borrow that much as well.
Yeah, yeah.
What if you already have a separate investment loan on ETFs? Can you just restructure this? So when you say pulled it back out, wait, let's do this one first. I think they're two separate questions. So what if you already
Hmm.
have a separate investment loan on ETFs? Can you just restructure this?
I mean, I don't see really the point of restructuring if you already have investment sort of loan, unless you want to change the PI or IO, or really whether it's backed as investment or backed as a owner occupier. But yeah, happy to have a chat about that one, because that one sounds a little bit interesting. And if there's room for savings, yeah, why not? I'm open to having a chat about that.
Yeah, the way I see some people do it is they kind of have their 50 to 100 grand and then have different loan splits. They'll have multiple
Mm,
different loan splits so they can kind of then go back and track when they bought the shares for each loan
mm.
split or whatever it is. But yeah, it really depends.
Yeah,
So
so
when
sorry, Tash.
no,
I'll
that's
probably
fine.
say one thing. So this is where actually the accountant will come in very handy. So it's good to sit down with the accountant and have a chat with them, saying, okay, how would you like us to sort of structure this, right? And then once the broker has an understanding, then we'll sort of liaise that according to the bank's requirement. So very important in that situation to have a chat with the accountant. Yeah,
Yeah. And we can chat to your accountant directly as well if
yeah,
they will chat to us.
yeah. I mean, I'm very
Um,
chattable, so I'm pretty
very
sure.
chattable, very
Yeah, I'm
chattable.
very
Yes.
chattable, so I'm pretty sure the accountant will be happy to chat with me.
When you say pulled it back out, you pull it out of a separate loan account, was the question.
Separate loan account, pull it back out. I'll probably go back to the example where you had the $600,000 worth of debt. So effectively what you did was you paid the debt by $50,000. And when you mean pull out, it's the simple term is you're creating a new split. Hopefully that answers your question. So you have now two loan splits. One is on the main residence, and one split is where you're actually deducting the debt.
What if you have both savings and equity in the home? Do you have to use your savings or can you just draw out some equity? I feel like we've answered that one now.
Yeah, yeah, a few times, but it's good,
Yes.
good, good. I think people are thinking beyond the debt recycling, which is great. Yeah.
hmm I guess the confusion is paying into your loan, not sure where or what that means.
Yeah, we'll have a chat, but effectively it's like repayments. I think we briefly covered it, probably not in detail. So if you have $10,000 worth sitting in your offset account, right? The idea is, what's stopping you from purchasing the shares with that? The what we mean by debt recycling is not just going out and purchasing shares with that $10,000 worth in offset. It's actually the way you purchase makes a difference on whether it can be tax deductible or not. I've seen many people sort of purchase shares from their offset, and at the end when they try to claim tax on it, the ATO would be like, well, that's not how we do things. So they have to sort of restructure it. So the idea being, there's a specific way on doing it, which is you have to pay down the loan, the non-deductible debt, and then
Mhm.
when you're taking it out, you're repurposing that loan purpose for it to be tax deductible. So hopefully that answers your question, and I gave you a little bit of off-topic examples, but yeah.
Yeah, I think it's to not overcomplicated. It's literally just paying more
Hmm.
into your home loan. However, you do that with your home loan. Do you BPay it? Do you have a direct debit set up? Can you just like transfer money literally to the home loan
Hmm.
account? I don't know how your loan is set up, but yeah, chat to a broker about this before you do it just to make sure it's all correct. But it's literally just paying extra into your home loan and then reborrowing it back out.
Yeah, I
Um,
just probably want to read a comment out there. I'm not too sure how to say his name. Dieter. Yeah, saying awesome Tash and Bro. I'm an old broker and father and love what you're doing. Well done. So really wanted to take the time to thank you for
Yay.
recognizing what we're trying to do. We're in planet Earth, survival of the fittest. I mean, and in today's modern finance world, the survival of the fittest is really how sort of looking at sort of your retirement and how you want to be financially free. Tash certainly believes in that, and I'm here to support it, guys. So thank you for that.
Yeah, I'm still a bit behind. There's so many messages, but yeah, thanks for pulling out the positive ones. Someone pointed out it's worth noting that mortgage payments increase as the loan has increased by taking out the equity. You have serviceability as well as equity. Definitely. If you come and chat to us, we'll run those numbers for you. We're not going to like do this and not tell you what it will look like. But yes, if you are taking out extra equity, then yes, your repayments will increase because you're borrowing more money. What is the first step? Do I ask the bank to do it? No, come and talk to us, hopefully.
Yeah, 100%. Look, one of the banks are great institutions. I mean, I love banks. Probably don't operate, don't love sort of like a few other things, but banks are great institution. But however, if you go have a chat with the bank, they'll be like, it's not my job, right? They're focused on KPIs and numbers, not necessarily there to help you. The broking model is where we're actually helping clients. So please have a chat with a broker. It's a fee free. You can either go to a financial advisor, pay like $1,500 minimum or $1,000, or you can come have a chat with a broker to confirm that back with your accountant. So, if the free service is there, come have a chat with us, really. I'll probably
Um,
read one of the questions out.
mhm.
I split my loan for a kitchen renovations, and ooh, sorry, I never end up doing it. Could I just use this money to buy shares? The from Alex Austin. Probably the question I'll ask you is, why didn't you do the kitchen renovations, man? And yes, the answer is yes, you can certainly do that.
Is the only risk when the interest rate goes up? No, there's lots of risks involved, I guess. Anytime you borrow money, there are risks, and anytime you buy shares, there are risks. There's many different
Mm,
things there, but the shares could drop. Yes, the interest rates could go up. You could lose
mm,
your job or be made redundant and not be able to make those repayments.
mm.
There's, yeah, a lot of different things that could go on. So all of the lending risks and all of the risks with buying shares still exist for sure.
Yeah, I'll probably touch upon this one here. If you compare, just think that you already have this debt. So if the interest rate goes up, if you didn't do the debt recycling, you'd actually be paying more to the bank. But if you did the debt recycling and the rates go up, guess what? That's tax deductible. You're going to get more back in your pocket at the end of the year. Sure, the risk goes up, or the rates goes up, but you're claiming it back. It's much better having a debt recycling sort of split rather than not having, if that makes sense.
Yeah, just the only thing to be mindful of is if these shares go down, and then if you sell your shares, you have the loan amount is higher than the amount of your shares, and then you're stuck with a
Mm,
debt. That's not
mm,
ideal, but
mm,
as long
mm,
as you have the spare cash flow to ride out the up and down waves of the market and buffers and plans for if you're made redundant and all of those usual things that we talk about in terms of
mm,
share investing. A few questions around minimum amounts. So, are there minimum
mm.
split amounts and are there minimum amounts that can be beneficial to invest from this strategy?
The minimum investment amount, probably not. The minimum split amounts, yes, that would be restricted to the banks. But again, say I'll give you a very simple example, right? So say the bank does minimum split amount of $25,000, but you only had $10,000 worth to invest. Yes, you can still do that. There's a structure that we can put in place for you to be able to do that. But yeah, you can certainly do that. The way we need to structure the split is according to the bank. But again, like if the bank's minimum split is 25 and you don't want to do 25, then it's like, oh, you're stuck. What do I do? That's when we would sort of create a strategy for you to be able to do that. So yeah, definitely speak to a broker about that. But yes, the answer is you can do it.
Can you change the split from principal and interest to interest only?
Yes,
Yes.
easy. It's a reapplication, by the way. Interest only is not a flick of a switch anymore. They changed that ruling, I think about like 2022 or 21. Can't remember. But yeah, you have to reborrow that.
What queries do we actually ask the accountant?
Well, actually, just what asset class do you need to purchase? Because the majority of the job, the broker does that for you. Say we split that in our example, say you split that $50,000, then you'd ask the accountant saying, "Hey, look, my broker's helped me do the debt recycling. I've got $50,000. What asset class should I purchase so that it's deductible under the taxation laws?"
Yeah, so
That's
you can
it.
say, I want to buy this ETF. They can check that it pays distributions or dividends. I would also chat to them about how it affects your overall tax position as well, because
Mm,
they can consider all of the other things going on in your life as well, like income from your job, if you have a business, other investment properties, whatever it happens to be. So just chat to them. They might recommend other structures like companies or trusts. I'm not really sure, but just ask them those kinds of
yeah,
things.
100%. As much as I love a spreadsheet, I think it's best to talk to an accountant about
Yeah.
that.
How to find one who knows about debt recycling. I have my accountant I can recommend if you guys want to use them. We can refer to you if you come and see us, and we work closely with her. Her name is Rebecca. So if you want a referral, just reach out and let us know, and we can send you her details. Please ensure there is clear traceability of funds flowing in and out of Pearler or the other brokers by the asset. Don't mix investment amount with other transactions. Keep it separate. Good reminder for sure. More amounts about minimum amounts of cash. Has anyone here actually debt recycled? And if you have, what was the minimum or what did you put in? I'm curious if you're here because a lot of questions about minimum amounts. When you're on a fixed rate, is it the same rate with the split loan? No.
I probably need to ask a few more questions around what do you mean by that. But in general, most of the general terms, fixed rate and variable rate have entirely different interest rates. Yeah. There was at
Uh,
one time, I think this was last year, back in October, November, where they sort of kind of were very similar. But then yeah, banks changed their threshold about fixed rates after that, and hence why we're seeing a bit of a higher rate now.
Can you do this with fixed rates? Because fixed rates limit how much you can actually pay into the loan to then pull out, right?
Yeah, I mean, look, technically you can. If you're looking to invest long term, say you're looking to invest for 5 years in CBA shares because now they've gone down by 10%. Yeah, 100%. Why not? You can interest only fix it for 5 years, and then you could claim that. But then you have to, again, it's about your risk tolerance. Are you comfortable to do that 5 years? Do you have enough cash flow to do that 5 years? What if you sell your house in 5 years, right? What if you want to convert it into investment? So there's quite a lot of questions that you have to ask yourself to be able to do it comfortably for a longer period. But it's only for 1 year. Yeah, why not? You can fix it. No stress.
Yeah, but if the loan, the initial loan on your home is fixed and this requires paying money into your loan and pulling it out, does that make it trickier then?
Oh.
Because you might have to break the fixed loan.
Yes, certainly. I think that would make it very tricky to be able to do that because the way fixed rate works is not all of the banks allow for you to pay down on your fixed rate. Some banks have a cap saying $10,000 for the term of the fixed rate. Some banks don't even have a cap on that one. So if you have a fixed rate, rather than complicating those things, what I would do is I just reborrow, create a new split, and why don't you put all your savings in there and then do it, right? So there's no need for you to complicate the fix. Leave it as it is, do the reborrow, and then you can keep your savings on there, keep your savings, and then with the reborrowed funds, you go ahead and do that. So my advice there is don't complicate that too much if it's fixed.
Just chat to a broker because there's different,
Yeah.
some banks are cheaper to break fixed than others as well and whatever else. So it really depends
Mhm.
on the loan that you have and the terms there.
Mhm.
How do you further increase the split after the initial split? So say an $850,000 mortgage, $100,000 paid and split to use for ETFs.
Mhm.
What's the steps to carry out, say, $5,000 increments as savings become available? Surely I don't need to create additional splits and can just increase the initial split once it exists. So I just have two loans that slowly change.
Good question there. So again, I'd love to sit down and have a chat with you about the strategy. The reason why, because in that particular instance, I want to be able to talk to the accountant. Sure, I know how to do it. I've studied accounting and finance, but I want to be able to talk to the accountant and make sure that that's still relevant with the current laws, right? The reason why I say that is because, $5,000 split, a bank's never going to allow you to do that. It's too much work for them, right? And then if you do it about 10 times, that 10 splits, that caps out most of the banks, right? So there's certain ways you can achieve that, but it's about sitting down and talking to the accountant of whether, how many times you want to do that split, or you want to say you're a type of person who wants to invest $5,000 every month for a longer period of time, 2 years, right? So we will create a structure for you so that way you don't have to split your loan every time to do that. We'll just create a lump sum structure where you can sort of just simply pull out the funds and then still comply with tax, but also still comply with the processes of the bank. And hence why I say this is where we definitely need to speak with an accountant to make sure that it's actually being deductible. We're not contaminating the loan or we're not mixing the purpose. So it's certainly a way to do that. We're getting a bit into the complex territory of debt recycling. But yeah, 100% happy to have a chat there.
Yeah, this is all very general information. It
Mm,
always
mm,
really
mm,
depends on current
mm,
situations, what
mm.
your like your tax, what your accountant says, and what we
Yeah.
can do, and what the banks can do, and how much you
Mm,
can borrow, and all those different things. So definitely chat
yeah.
to us for specific things.
The final thing I'll probably touch base on is when you're doing smaller amounts. I'm sure you have all of these questions there, but at the end of the day, would it really be worth for you to do the smaller amounts, or would it really worth for you to sort of kind of you know build that saving position and then do it in a lump sum so that it's easier for everyone, for accounting, for yourself, and for the broker as well. So
Yeah.
hence why sit down, have a chat, and see if it's worth it. Then you do the 5,000. If it's not worth it, then you'll probably want to do a higher amount.
I know some people will save the money in their offset, so they're still getting the tax benefit there while they're saving it up, and then they save to the 50, 100 grand, whatever it happens to be, and then they'll debt recycle at that point. But
Mm,
we can
mm,
run all the numbers for you, definitely.
mm.
Do you have to tell the bank what the split loan is for?
Uh, I mean, you're literally just splitting the loan. Yes, technically, you need to tell the bank what you're splitting the loan for, but you could say for personal investments, no problems there. I've never had a run into issue with the banks.
Are your services free? Yes, we are paid commission by the banks. It's pretty
Mhm.
consistent across all the lenders, so we're not incentivized to go with one over the other. But yeah, they pay us for bringing them the customers, I guess. So yes, we are free to the customer, which is very fun.
Perfect. And my service fee is very nominal. I only charge $1 million alone. So feel free to reach out, guys. I'm here to
Great.
help.
That is one of Rose's jokes for anyone who doesn't know. It's free. Or
It's free.
complimentary, I think I meant to say, with the rules. If $50,000 is already invested in ETFs, can previous bought shares be restructured to debt recycle? I think
The answer is no to that. Yeah. And that's when we require to restructure. I've done plenty of times, but it's a good way of looking at it. What you really have to do is you have to sell your shares and restructure and then rebuy it. Of course, there's a little bit of cost involved to it, but again, you look at the longer run, it'll probably be a lot more beneficial. Hopefully that answers the question.
I think this is an accounting question, but I'll read it anyway. If the
Mhm.
PPOR is under my name, can I debt recycle and purchase ETFs through a trust?
Um,
My first response to this is like, does that take away the benefit of doing it to debt recycle? Yeah, actually, I don't know. I think I'll ask an accountant. I don't want to say the wrong thing here. Yeah,
yeah, I'll probably steer away from this question,
yeah,
but yeah,
fair.
definitely have a chat with the accountant.
I've heard that debt recycling was beneficial when interest rates were low, but now that interest rates are high, it's less favorable. What are your thoughts? Definitely the higher interest rates go, the less favorable it is to take on more debt because you have to pay more to hold that debt.
Mhm,
Um, you have to work out the benefits here in terms of the tax savings and the possible growth in income from your investments compared to the cost of actually borrowing that money.
mhm.
But yeah, the higher interest rates get, the less beneficial it'll get. But that's, yeah, definitely run those numbers and see.
Yeah, I think there's two viewpoints here. One viewpoint is consider you purchase this without debt recycling versus the debt recycling. Debt recycling is always a favorable way in terms of financial and long-term sort of well-being. If you're thinking about whether I have this money, whether it's worth for me to sort of go purchase shares and do the debt recycling, then again, it comes to a risk threshold. I mean, at the end of the day, it's about running the numbers. It'd be great to purchase shares when the interest rate were 2%, but is it good still to purchase the share when it's 6%? And is the share going to go up in value so much that it's going to be worth it? Longer run, I always say yes, that recycling is good. And then obviously you get two things. One is you get the tax deductibility. Second one is you get the appreciation of the price of shares. If you're looking at a longer term, I look 100%, it's worth it. But if you're looking at shorter term, then that's where you really need to consider whether you want to just save that money for your cash flow or emergency fund, or you actually want to do that debt recycling. Yeah.
Yeah, this comes back to just the general conversation around risk tolerance. So
Mm.
personally, I don't pay extra off my mortgages because I would prefer to diversify and buy other assets, not have all of my wealth in one or two properties because I find that a bit scary. But if you don't like debt and you're uncomfortable with debt and it's really stressful, then maybe you will just pay it off rather than doing this.
Mm.
But yeah, it really depends. Um, Another fun one. If you set
Okay.
up a debt recycling facility, then refinance your existing loans, how do you ensure the bank keeps the loan split separate during the drawdown process? For example, a friend had a loan split of $500,000 PPOR and $100,000 for debt recycling. When they refinanced, they increased the split for debt recycling for 120K, but only had 100K owing the bank. The bank mixed the loans on the drawdown by taking 120K in the drawdown from the debt recycling split and 480K for the PPOR. Does that make sense? Sorry, I read a lot of words out.
Yeah, yeah, it does kind of make sense. So I'd probably say that there was an error from the bank because obviously from a taxation point, again, just a bit of disclaimer, I've got an accounting degree, but I'm not a tax agent, not a practicing one at least. So it's incorrect. You can't increase your debt from $100,000 to $120,000 and do that debt recycling on that because that $20,000 it's not you didn't use that for the purchase of shares. There's a little bit of caveat there where cost of refinancing, can that be claimed? That's what you need to ask the accountant, but that would be the incorrect structure. You cannot do that. It has to remain at $100,000. If there is a $20,000 cost of sort of refinancing, that has to be attached to the loan itself. So technically, to keep it clean and simple, when you're refinancing or restructuring, make sure that the debt amount stays the same.
Yeah, I think the workaround here is just see a broker who knows what they're doing with debt recycling, and
Mm.
then they can help the bank do it properly. If you go direct to the
Yeah.
bank, it might be tricky if they're not entirely sure what you're asking for.
And the final thing I'll probably say in that particular scenario is you pretty much mixed the purpose of the loan. I mean, sure, it can be rectified by sort of creating a new split, but then at the end of the day, the accountant is going to charge you a lot more money than otherwise when you should have kept it simple.
Yeah.
Yeah.
Someone wants Rebecca's the accountant's details. Can you just send me an email, like hello@tashlens.com, and I
Mm,
can refer you to her? That's probably the easiest.
mm.
Um, yeah, lots of people debt recycling. I'm currently Corey said he did an 80K split, paid it down and drew the loan down in 10K increments every month. Andrew, yes, when we purchased, we had 100K left over, split the loan and have debt recycled $66,000. We have debt recycled, but our bank didn't do it the right way. He gave us a new investment loan and we still have all our money in our offset off the home loan. Sad face.
Yeah, that's I'll probably say this when clients come to me, because that's a really good point. Sure, banks are there to help you, but when clients come to me, they have very similar sort of sentiment about the bank, saying they didn't sort of kind of guide them through properly in terms of their debt recycling, and because of that, the the shares became non-deductible in terms of the money that they use. I'll probably say that the bank, most of them don't know what they're doing in that sense. So hence why broker accountant combination is deadly if you want to do the debt recycling, deadly in a good way. Yeah.
Positive deadly.
Yeah, it's positively
Um,
deadly.
oh, would there usually be a fee to create the split loan?
I mean, I charge $1 million per split, but again, like, no, I'm just joking. No, there's generally no split fee. The only one that I can think of is banks have this fee called fee for variation, which quite a lot of the banks now are sort of changing their view on. Initially, there used to be if you made any variations in your loan, for that variation, there's a specific amount of fees, but most banks are sort of withdrawing that now. But it really depends on your bank. The answer to that question, really.
Can you do anything combined with your super with these strategies?
Uh, Super is probably a no-go because super is just in your super really. If you could technically they're all shares, right? Unless it's a self-managed super fund, which is all a different.
Yeah, but I assume you could just split the loan and then put money into super if you want to borrow money to put into your super. But yeah, just be mindful of that if something goes. I'm not sure what banks think of this, but if something goes wrong, you can't really get the money out of your super to pay off the loan. Actually, I don't know if the banks would like
Oh,
that.
that's okay. That's the other part of the question. Okay. Yeah, to be
Hmm.
honest with you, I'll probably say I'm not sort of confident on answering that sort of
Yeah.
question. I would think that it's separate. Probably need to ask a lot more questions around what you really mean about
Yeah,
that. But
what's the goal here, I
yeah.
guess. But yeah, let's leave that one. I'll have a think on that one. That could be an
Mm.
interesting podcast episode. I'll
Yeah,
save that one.
100%. Yeah, I'm keen to know more about it actually now.
Yeah. I'm trying to think of all the different risks that could be there too.
Yeah.
Our bank asking a lot of questions. Bank Australia. Oh no, my thing moved down. Okay, sorry. So many questions. I lost the one I was reading.
Our bank asking a lot of questions, Bank Australia. I think they are fairly conservative. We have, a certain amount in equity, but they are still wanting more details. Oh, okay. So,
Banks do want a lot of details. Sometimes
yeah,
they
banks.
ask.
Mm.
Sometimes they ask
I,
lots of questions. Some ask less.
I'm actually not so sure what the question is. I know the bank is asking question, but what question are they asking, and what is Jane asking question? So there's a lot of questions here. We'll move on to the next one.
I think it's misrepresenting to say that you still have the same amount of debt. If you had a 600K loan and 50K savings, you have 550K debt. You would be taking out a 50K loan back up to 600K to buy shares, right? Which is fine if you were buying shares. I'm confused about this one because if you put it in and then take it out, your
Uh,
debt position is similar.
is that
Yeah.
a question to me?
Yes. So the thing was, I think it's misrepresenting to say that you still have the same amount of debt. I'm not sure what the
Mm,
misrepresenting part is. If you have a
yeah.
600K loan and 50K savings, you have 550K debt. You'll be taking out a 50K loan back up to the 600K to buy shares, right? Which is fine if you're buying shares anyway.
Mm,
I'm
I'll
confused about.
probably, yeah, it's we probably need to ask a little bit more questions to Mark to see what it really means here. But technically, it's not misrepresenting. What I'd probably say is it's who views the loan and in what sense. So if you're having a look at from the bank or the financiers, the person who's lending you the money, your total debt is still 600, regardless of if you how much you have in the offset or savings or redraw, right? At the end of the day, the way you have to look at it is if you sell the property, how much debt do you have to pay the bank? It's still 600, regardless of how much ever money you have in your offset or redraw, right? So you still owe the bank, $600,000. But from your point of view, Mark, there, so if you paid down the home loan, right, you only have $550,000 worth of debt. But that $50,000 in that case is not usable, right? So if you want to go in and take that $50,000, right? So say to pay out your shares, how much debt do you have remaining? It's still 600, right? So it's really kind of there's the question of who is viewing that particular debt. That reminds me of the story where, there's two people sort of kind of looks at the duck. One says, hey, the duck is golden, and the other one says, hey, the duck is not, and the duck is silver. So why did you guys switch sides? And then you'll see the both side of the thing. So it's very important in that sense to have a look at that particular debt from a different angle. If you're only looking at it from your perspective, yes, there might be a misrepresentation. But if you look at it from a holistic perspective, that way you'll understand a lot more about that particular debt. So what we're doing is we're educating people to understand how banks view that debt and how there's different ways for you to sort of manage that debt. And at the end of the day, that's the message we're trying to say.
Yeah, we're trying to simplify something that
Yeah.
has lots of variables and can be quite
Mm,
complex. So the overall
mm,
message of this is like we're giving you a general idea, and then you can come chat to us or another
mm,
broker or a bank if you'd like, and your accountant to see how it works for you and your situation and how it impacts you. But yeah, we're just trying to simplify this. So sorry if it comes across as misrepresenting, but it's just
mm.
kind of like Anna and I like to say, it's like legal money laundering, where it's your money, you're just moving it around to get benefits. Jessica has a really good point, actually. With super, you can't debt recycle, from what I understand, as you need to acquire an investment that produces accessible income for you personally. And when you contribute into super, the investment is owned by the fund and hence income tax within the fund, so not tax deductible to you. Very
Perfect.
good point.
Yeah.
It doesn't mean that you can't borrow money to put it into your super, but this specific strategy we are talking about is not ideal for that. But again, it
Mm.
goes to what's your overall goal here and what can you do to achieve that goal? What time is it? We've got 3 minutes. Let's do. One or two more, maybe. Are there any that you like that I haven't asked you, Ro, if you've been paying attention to all of the questions coming through?
Oh my God, there's a few questions. It's a bit hard to keep a track of that, but look, loving the questions here.
Yeah.
Obviously, the more questions you ask, I think it's the broader audience has a lot more understanding on that, and that's what we're trying to achieve at the end of the day, just so that you can, there's some sense that you can clearly understand it. Again, I wouldn't recommend just a little caveat, like I wouldn't recommend you going out there and doing it on your own. Sure, and if you're a mortgage broker, sure, you want to learn about it, this conversation is helpful. But if you're actually trying to do the debt recycling, then yeah, just come speak to a broker. I can't stress
Yeah.
out how important it is. It's a free service, guys. And like it's yeah, just come have a chat, 5, 10 minute chat. And buy your mortgage broker a coffee while you're at it.
Oh, asking for benefits. Last one I'll answer. What's the main pro to this to pay your mortgage down faster? No, the main pro is trying to save money or save, I don't know, save money on tax, I guess, by turning your non-deductible home loan debt into deductible debt is the whole goal of this specific strategy.
Mm.
For more information, you can head to our website, not about debt recycling, but just we've got general fund calculators there. Aussie Fire have done an episode on this. We did one on my Get Rich Slow Club podcast with Anna kind of sharing her journey and why she debt recycled and how she set it up. Pearler have some cool articles as well if you just Google debt recycling and Pearler. Um, you can scan the QR code to book in with a broker. I might try and exit and just show you as well. I don't know how to escape. There. Everyone asking for my email. It's just hello@Tash Lends. And I can introduce you to Rebecca. So just put like accountant referral in the subject. Oh, sorry, hello@tashlens.com. But yeah, so many more questions here that we didn't get time to answer. Feel free to send us an email and we can try and help you out, or just book in a call with us. You can scan the QR code, or if you come to our website, you can just book in here as well. And you can, if you've got a broker already, you can just reach out to them and see if they will help you too, or come chat to us. Either doesn't really matter. Any final words, Ro?
Final words. I'm trying to think of something funny to say.
Ro loves to start the day with a dad joke,
Yes, I
every
do. I
morning.
do. I do. I do. And they're very
Do you have?
terrible. I see people cringing all the time, but it's okay. And as long as I can lighten people's day. I think the only thing I'd like to say is if you feel like this, this session's been helpful, obviously, thanks Tash for it because they're sort of kind of all helping us understanding, and navigating this financial landscape a lot better. So yeah, just go in and follow Tash or, thanks Tash, really.
Is anyone really surprised about my desktop? Sorry for those who got to see it briefly, but welcome to
Your
my messy
screenshots
brain.
are hurting my eyes. I kind of said this similar thing to Tash.
Yeah, I don't really want to clean up my screenshots. Just what's the need? No, it gets to a point where like things are too get too far and it's like, oh well, it's just how it is now. Um,
Yes,
yes, you can book in. So the team is set up. There's Ro and Adam. If
Adam.
you want to speak to Ro directly, just add a note in the comment, and I can always change it over to Ro if you really want to speak to him directly. But Adam is also really great and lovely. We also have two credit analysts. We have Sam, who used to be an accountant and loves tax, so he's really helpful with this kind of stuff. And Hayden, who used to work at Entourage, which is like a brokerage for high net wealth people. So he's really experienced with things like trusts and companies as well, and things like debt recycling too. So we have a great, very experienced team, and you might chat to any of them. But yeah, if you want to chat to Ro specifically, just put a note and I'll change over your meeting with him. Yay, thanks everyone. Bye.